Good day, everybody. Welcome to the Overberg Asset Management review of the global markets for 2025, as well as the 2026 outlook. Nick Downing will be presenting. He is the CEO and Chief Investment Officer at Overberg Asset Management.
The agenda is the Global Economic and Market Review, Economic and Market Expectations, Projected Asset Class Returns, OIM Global Portfolios, and a summary.
Without further ado, Nick.
Thank you very much, Elsa, for your kind introduction last year when President Trump shocked markets with his Liberation Day reciprocal tariffs. Global economic growth proved remarkably resilient in 2025, testimony to the strength of supply chains and strong underlying demand. The US remained the engine of global economic growth. Its GDP registered in above trend growth rates of 4.3%, quarter on quarter annualized in Q3, accelerating from 3.8% in Q2. Powered by robust business spending led by the AI investment boom. Elsewhere, cyclical and structural conditions in the euro area, Japan, and emerging markets have been gradually improving, helped by widespread central bank interest rate cuts. Despite representing the world's growth engine, the US dollar weakened in 2025. The US dollar index lost 9.8% over the year as the relative growth pendulum swung in favor of non-US economies, and relative interest rates exerted downward pressure on the currency. Elevated US policy uncertainty sparked capital outflows from the US, adding to dollar weakness. Ironically, US trade tariffs intended to shore up the current account had the perverse effect of accelerating capital outflows. The flip side of the historic current account deficit has been the massive US financial and capital account surpluses, which are now reversing. Financial outflows tend to be much faster than any potential rebalancing of global trade. As the year progressed, market anxiety shifted from the threat of recession to a potential bubble in AI stocks. Market leader NVIDIA's Q3 results massively exceeded all forecasts, and yet its stock price fell. A worrying divergence in the performance of the Magnificent Seven stocks signaled increasing scrutiny from investors amid questions over the accounting treatment of AI investment and the rising use of debt to fund it. AI fatigue, combined with a broadening in global economic momentum, led US equity markets to underperform their global peers in the past year. A weakening dollar amplified the trend. Despite underperforming, the S&P 500 index scaled numerous record highs during the year, rising a further 2.3% in Q4, capping a 16.4% annual return. Although US equities enjoyed strong gains, non-US equities decisively outperformed in 2025. The global equity market experienced major swings and an underlying rotation last year. The dotted line compares US versus non-US indices, while the dark line, which gives an equal weight to all index stocks, thereby neutralizing the effect of mega-cap stocks, shows an even greater underperformance by US equities. In other words, were it not for the concentration of the magnificent 7 stocks, the US market would have underperformed by even more. Japan's Nikkei index surged 26.2% over the year, German's DAX by 22.6%, and the UK's FTSE 100 by 21.5%. The MSCI All Country World Index, dollar-based, gained 19.8%, although emerging markets led the way, helped by cyclical and structural tailwinds, as well as a weakening dollar, pushing the MSCI Emerging Market Index, also dollar-based, up by an impressive 32.9% in 2025. Emerging markets tend to flourish amid improving global trade, broadening growth, and a weakening dollar. The price-earning multiple of global equity markets increased as markets gained by more than the rate of increase in aggregate earnings. The trailing PE of the MSCI All Country World Index re-rated over the year from 21.5x to 23x. And the MSCI Emerging Market Index from 15.1 to 17. Japan's Nikkei and China's CSI 300 re-rated from low valuations, the Nikkei from 15.7 to 17.9, and the CSI 300 from 12.9 to 14.5. Although the Euro Stoxx 50 barely re-rated as its PE adjusted from 15.4 to 15.8. US markets remain the outlier, with the S&P 500 re-rating from 28 to 29.1. A 12-month forward earnings basis, PE multiples are less demanding. The estimated S&P 500 forward PE winds down to 23x. But this is still high versus its own history and at a historic premium to other markets. We're now going to move on to economic and market expectations for 2026. The Global Purchasing Managers Index, which is well above the neutral 50 level, which demarcates expansion from contraction. The composite index measures conditions in both manufacturing and services sectors. Both are expanding, and the expansion is broad-based across all the major economies, thereby boosting overall global resilience. Global growth is on track to improve in 2026, representing both a pickup and a broadening in growth momentum across economies. The Federal Reserve, in its December policy meeting, lifted its US GDP growth forecast for 2026 to 2.3%, up from its 1.8% target given in September. But the growth gap between the US and the rest of the world should narrow, with improving growth in non-US regions, which are less advanced in the economic cycle. Emerging market economies in particular are highly leveraged to improving global trade and economic growth. Healthy earnings growth is expected to derive from the positive global economic outlook. Global earnings are projected to rise by 14% in 2026, according to consensus forecast, with aggregate double-digit gains in both US and global non-US economies. Although earnings growth expectations are highest in emerging markets and the euro area, both enjoying the biggest recent upgrades to estimates. Emerging market earnings are projected to rise 18% this year, while US and Euro area earnings are forecast to rise by 16% and 15% respectively. Earnings expectations in emerging markets and the Euro area have been upgraded by the most over the past 6 months. Both fiscal and monetary conditions are conducive to upside growth surprises. In the US, Euro area, China, and Japan, governments are primed to launch fiscal stimulus. Meanwhile, the Fed cut its Fed funds rate by a total 75 basis points between September and December last year, with a further rate cut expected in June after the new chair takes over with the expiry of Jerome Powell's term in May. In December, the Fed announced a resumption of asset purchases, formerly known as quantitative easing. Other central banks are close to, if not at the end of their easing cycles, although there remains scope for further easing from the ECB and Bank of England. Overall, monetary conditions are accommodative and liquidity is plentiful. The US dollar is likely to succumb to further easing in 2026, as the currency is buffeted by both cyclical and structural factors. Structurally, the dollar may lose its safe haven status as capital outflows remove its defensive characteristics, especially as much global policy uncertainty is homegrown. Cyclically, the relative growth advantage against other currencies is expected to dissipate as global economic growth broadens. Relative interest rates will also put pressure on the US dollar, as the Fed is some way behind in its interest rate easing cycle, and the high level of US government debt and persistently large federal deficits point to further depreciation. The dollar remains expensive relative to its historical trend. The real trade-weighted dollar is still 14% above its long-term trend line. Looking at the elevated starting point on the chart, and if history is any guide, the US dollar could depreciate by 25 and 30% in the coming year. Inflation is the key risk to the current Goldilocks environment of robust GDP and earnings growth, coupled with accommodative monetary policy and fiscal stimulus. When policy stimulus is provided at a mature phase of the economic cycle, as exists currently, there is a danger that it boosts inflation as well as economic activity, as remaining spare capacity is limited and labor markets are tight. The transmission of an inflation shock to financial markets would occur via the bond market, with a rise in the 10-year Treasury bond yield leading to a repricing of financial assets and a compression in equity valuation multiples. Ominously, 30-year sovereign bond yields have been rising across developed markets despite ongoing monetary easing, signaling a potential rise in shorter dated bond yields. Policy errors could also ignite a spike in bond yields. Attention is fixed on rising public debt levels and fiscal credibility, with bond markets scrutinizing any potential policy misstep. Economists tend to err on the side of caution. Indeed, bull markets climb a wall of worry, but there are numerous upside risks that are also worth mentioning. Notably, the recent improvement in US productivity could be a precursor of a more durable and widespread upswing in productivity driven by the rollout of AI technology that starts to spread to other countries. The AI adoption and investment cycle may still be in its early phases by industry and by geography. Businesses and governments across the world are racing to invest in AI in search of productivity gains and out of fear of becoming obsolete. A replay of the late 1990s dot-com boom suggests another 25 to 30% upside for US stocks in an AI melt-up scenario. Assuming current 12 months earnings forecasts and using a similar PE valuation. If equity risk premium comparables are used, the upside could be even greater, given that the real interest rate measured by the 10-year US TIPS yield is so much lower today than in the year 2000. Now, let's move on to OAM's global portfolios. In Q4 last year, we sold Pershing Square Holdings, taking profit from a significant re-rating. The share had been held in OAM's global growth portfolios since November 2021. By the time we sold the share, it had risen by 70%. Proceeds were switched into 3i Group, taking advantage of its 25% share price decline over the prior month, when it derated after showing weaker than expected sales growth from its largest holding, discount retailer Action, which comprises over 70% of 3i's NAV. Sales weakness at Action is attributed to cyclical effects in France rather than any systemic problem. Before the derating, 3i's share price traded at a dangerously high premium to NAV, exceeding 50%, but now trades at a slight premium of just 5%. The lower valuation offers an excellent opportunity to gain exposure to this winning private equity investment company. OAM's portfolios have US weighting in a range of 40 to 50%, depending on the risk profile of the portfolio. Nonetheless, Overberg's global portfolios have a slight underweight to the US and have benefited from this and their diversification across global markets. We are sticking to this position in anticipation of a broadening in global growth and a weakening US dollar, which will benefit non-US earnings in both absolute and relative terms. The exposure that we do have to the US is focused on AI, which is expected to be the main driver of that market in 2026. OAM's portfolios have a significant weighting in Europe, in Japan, and in emerging markets, which are well placed to maintain their outperformance in 2026 amid improving cyclical economic conditions. These markets trade close to record discounts to the US. On a global matrix, earnings growth estimates in 2026 are highest for emerging markets and Europe, and are being upgraded in these regions at the fastest pace. Profit margins are also lower than in the US, providing a better cushion against disappointment. In Europe, inflation has returned to the ECB's target, and households are sitting on huge excess savings. Fiscal stimulus led by Germany's €1 trillion infrastructure and defense initiative marks the end of a decade of austerity. In Japan, the earnings outlook is improved by fresh fiscal support under new Prime Minister Sanae Takaichi, who is also a key proponent of economic reforms. Emerging market earnings are projected to rise 18% this year, and upgrades can be expected in line with improving global trade and expected dollar weakness. Emerging market valuations are compelling, with a forward PE ratio at a 30% discount to the global benchmark. The AI bubble is likely to keep inflating. AI earnings momentum is still very strong. Indeed, earnings growth in the tech sector has been faster than during the dot-com era. The AI adoption and investment cycle is still at an early stage, and the AI rollout and data center investment boom has much further to run. Both reported CapEx and analyst projections for future investment keep being upgraded. With AI valuations being high, admittedly, they are still some way below the dot-com peak in PE terms, and in terms of their equity risk premium, they are lower still, due to much lower real interest rates compared to then. Portfolios are sticking to a high global AI exposure, both in the US and outside it, where valuations are more compelling, predominantly in China, Japan, South Korea, and Taiwan. There will come a time when global equity markets do correct, perhaps sharply, most likely led by the US, which trades at a record high premium to the global non-US average. What are the early warnings of an impending bear market? By far the most reliable and tiniest cues are found in bond and credit markets. Bond and credit investors are more risk averse than equity investors, and therefore more reactive to the slightest shift in outlook. Bond and credit spreads rise well ahead of the onset of recessions and provide an early warning of deteriorating financial conditions, but currently show no sign of impending recession. For the time being, despite elevated valuations, none of the indicators we follow are flashing imminent trouble for equity markets, and we expect the bull market will be maintained over the next 12 months as earnings continue to climb. There is far greater risk being out of the market than in the market, even with increasingly frothy conditions in some sectors and asset classes. Legendary investor Peter Lynch gave the warning that far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. The chart shows a selection of forecasts made by independent research firm Capital Economics for major equity markets in 2026, the light bars, and in 2027, the dark bars. Double-digit returns are expected in most markets in 2026. Valuations will eventually become sufficiently stretched that a correction is likely, but most probably not until 2027. Note that these are local currency forecasts. Expected dollar weakness would undermine the relative performance of the S&P 500 index in common currency terms. OAM has a long, successful track record in managing global private share portfolios, going back to 2002. A £100 sterling investment 23 years ago would now be worth well over £500. It has not been a straight line, but it is not timing the market that compounds investment returns, but remaining in the market. The annualized return in pound sterling net of all fees is 7.3% over the past 23 years, and in rand terms, 9.58%. 2025, showed in the table as year-to-date, YTD, was a good year in terms of relative performance, with the OAM Global Growth portfolio beating its benchmark by a decent margin. Benchmark outperformance is also evident over the past 3 years and since inception in 2003. Asset allocation and global allocation is diversified across asset classes, regions, and currencies in a privately actively managed multi-asset class global portfolio. The OAM balanced portfolio shows a similar trajectory, although due to its lower equity exposure, exhibits less volatility. The annualized return is in fact slightly above that of the growth portfolio due to unusually strong returns in the bond market in the decade following the 2008-2009 global financial crisis. The annualized return in pound sterling net of all fees is 7.48% over the past 23 years, and in rand terms, 9.73%. 2025, shown in the table as YTD, was a good year in terms of relative performance, with the OAM balanced portfolio beating its benchmark. Benchmark outperformance is also evident since inception in 2003. And now, ladies and gentlemen, for the summary. Global growth is on track to improve in 2026, representing both a pickup and a broadening in growth momentum across economies. Fiscal and monetary conditions are conducive to upside growth surprises. Healthy earnings growth is expected to derive from the positive global economic outlook, although earnings growth expectations and upward revisions are highest in emerging markets and the euro area. The US dollar is likely to succumb to further weakness in 2026. The real trade-weighted dollar is still 14% above its long-term trend line. The AI bubble is likely to keep inflating. AI earnings momentum is still very strong. The AI adoption and investment cycle is still at an early stage. The sharp rise in the 10-year US Treasury bond yield to a new cycle high, driven by sticky inflation or fiscal credibility concerns, poses the biggest risk to financial markets. Valuations are high, especially in the US, but AI stocks are cheaper than in the dot-com boom and trade on stronger fundamentals. None of the indicators we follow are flashing imminent trouble for equity markets. Beware of being out of the market in a potential melt-up scenario where AI stocks rise by another 25 to 30% before correcting.
Thank you, Nick. What an insightful analysis. If you have any more questions, please email your wealth manager or also info@overberg.biz. Thank you so much for your time.